It's Wednesday, March 13th. Welcome to Market Foolery. I'm Chris Hill. Joining me in studio today, Aaron Bush in the house. Thanks for being here.
Thanks for having me, Chris.
We're going to dip into the Fool mailbag. We will get to Spotify's battle with Apple. I want to start real quick, though, with Aurora Cannabis. Shares of Aurora Cannabis up 10% this morning, and that's because the company has named Nelson Peltz to be a strategic advisor. And for those unfamiliar, Peltz, longtime activist investor, a lot of experience in the consumer goods space. He's on the board of directors at Procter & Gamble, Mondelez, Wendy's. I'm less interested in what you think about Aurora Cannabis, although feel free to weigh in on that. I'm more interested in how you view activist investors, because I saw this story this morning and I immediately applied a positive reaction to this situation because of Peltz's experience in consumer goods. I thought, oh, you know what? That's a good move by Aurora Cannabis.
Yeah, so I think for Aurora, it's better for them to have Nelson Peltz than not have him, but I'm not sure how big of a deal it is for them. So they're a medical cannabis seller. They have lots of different partners. So already, even though they don't have that much sales, they kind of already have the makings of what like a large conglomerate would look like. So it makes sense why he's coming in. But I do feel like people are overplaying this. It's really just like the mix of cannabis, Peltz that is, causing noise. But I mean, really just coming on as a strategic advisor isn't that big of a deal. I think he has some options, but if he really believed and the upside for this stock right now, which it's a $10 billion valuation, it's trading at about like 100 times sales. I think he would just be buying the stock instead of just options. So I think that says something about Aurora. But yeah, on the activist front, I think that's an interesting question. I definitely do think that activists play a role in helping more legacy companies improve their efficiency. And you see that a lot with conglomerates. Interestingly enough, I don't actually pay that much attention to activists or care all that much because I spend most of my time looking at internet businesses, and those tend to lend themselves less to what would make an activist get involved. Something like eBay is kind of like the obvious counterexample because they turned into a conglomerate of all sorts of different things. And so in some ways, it really wasn't that different from a large consumer-facing conglomerate of like goods. But I think, when it comes to software, when it comes to marketplaces, there isn't that much that an activist can do. So I don't think activists will play as much of a role in internet companies as they have in like the physical world-based companies. So
you haven't been in a situation where you're looking at the companies in your portfolio and a news item pops up that, activist investor Joe Smith or Jane Smith has suddenly, taken an 8% stake in you. You haven't been in that situation yet.
Yeah, well, I think it has happened. And when it happens to one of the companies that I own, I am definitely interested. Yeah. Right? If like Carl Icahn comes storming in trying to stir some noise, of course it's worth looking at. And you mentioned this before taping, but John Malone, he's not really an activist by a traditional sense. He's just like an epic deal maker. Whenever he makes moves, and he's covered a lot of the entertainment spectrum over the years. Yeah, it's worth paying attention to what he's doing and watching because it probably points towards where the future of entertainment is going. So I do think it is worth looking at, but I don't really think about it until it pops up in my portfolio.
All right, let's move on to Spotify. The company filed a complaint against Apple with the European Commission's antitrust regulators, claiming that Apple Music has an unfair advantage over rivals. CEO Daniel Ek published a blog post today saying that Apple's control of its App Store deprives consumers of choices and puts unfair restrictions and fees on competitors. Before we get to your thoughts, I'll just say that
Sure.
I'm unsurprised by this story. I'm unsurprised that Daniel Ek feels the way he does. I haven't seen a response from Apple yet, but I'm sure their lawyers are working on one.
Yeah, so I think he's right for the most part. I do think that Apple should be able to have its own music app. And in some ways, just because it it owns the entire ecosystem, that app is at an advantage. And in some ways that is okay because it's like any other like private labeled good. It's a private labeled app. But when it comes to restricting what other apps can do and really prioritizing your own app over others, and part of the antitrust issue with Apple, and this applies not just to Apple, but like we could go through all of these different tech companies and talk about their antitrust issues. But for Apple in particular, yeah, I do think that we will see antitrust issues emerge with the App Store because they take a 30% cut of every single transaction. I don't think they probably should take a cut of every single thing that happens. But furthermore, when they start imposing rules that stop companies from linking to outside websites where they can then do payments there. Once Apple starts imposing rules that like limits what those companies are flexible of doing outside of its ecosystem, that is like the purest sign of a monopoly, and that is something where I think regulators should get involved with. And I do think that affects Spotify to some degree, but it's not just them.
Well, and Spotify filed in the EU because that's where the company is based. It also happens to be the same place where, what was it, last year, was it a $5 billion penalty against Google?
Yep.
Yeah. So
if you're going to do it anywhere, it's probably a good place to start.
It is, and it also helps in the case that that's where Spotify's based, so that they're covered from that standpoint. But so let's go through a couple of the others because this is. Look, our proximity here at Fool Global headquarters to Capitol Hill is such that maybe more so than other parts of the country, we're aware of the noise from Capitol Hill. And the noise lately with respect to big tech from both sides of the aisle, as they say, is big tech is too big.
Yeah, and I don't want to get political, and I don't even think this has to get political. I think I applaud that there are politicians who are willing to bring this up and have the hard conversations of what does a modern internet-based monopoly look like? Because it is very different from the monopolies of old. But I do think that they are missing the point in a couple key ways. And then I can talk about a couple of the other companies. But one way they're missing the point is just overgeneralizing tech. Like, tech is not an industry. Like all of these different large companies, they compete with each other in some ways, but like fundamentally, they're very different businesses. Amazon is retail. Apple sells like phones and tablets. Google is search. Facebook is social media. These companies are all different, and they shouldn't be thought of in the same exact way. Second, the monopolies of today are different than they have been in the past. Standard Oil was a supply side monopoly. They owned all the supply, and consumers had no choice but to go with them. That is bad for consumers. But today, you look, the reason why Google, the reason why Amazon, Facebook, they're so popular is because they use technology to create the best solution for consumers, and consumers chose them. People can still go to Bing. People can still go to Walmart and deal with e-commerce. No one is stopping them. So I think it has to be less about just the fact that they have so much market share, and it has to be more about looking at the particular actions that they take and deciding whether or not it is best for consumers or otherwise. So I think those are the big main things, but they are right about some things. There should be probably limits placed on acquisitions. We need to look at the specifics like we just talked about with Apple. I think just if you go look at the proposals that have been made, we can start with Alphabet and Google. I think Elizabeth Warren recently called for them to separate their ad business from their search business. Which essentially just means like stripping out DoubleClick, which they acquired a long time ago, which frankly makes no sense because the business model for search is advertising.
I was going to say, that sounds like it would maybe kill is overstating it, but it sounds like it would seriously impair the business. Yeah,
like what would the business of search be if you were to strip the ad business away from it? Would it just be going back to the same like banner ads of 20 years ago? This business model is what is best for consumers. I think, however, when it comes, you can dig into the nuance and look at things like when Google places their own results to their own sites above others. In some ways, you could say, hey, that actually is better for the consumer because they know exactly what to give them and they own what they can give them. But is that anti-competitive? I think the answer is yes. The EU has determined that it is that way, but I think there are a lot of individual cases that need to be worked through. We talked about Apple. Amazon, I think they're calling the proposal, I was surprised the proposal wasn't to split off AWS. It was to split off the marketplace business from like the core retail business. And so the marketplace business is like the third-party sellers versus the first-party sellers. And again, that doesn't make sense because half of what Amazon sells is first-party stuff where they buy at wholesale from the suppliers and sell to consumers. And the only reason why the third-party suppliers are there in the first place is because Amazon's done such a good job like bringing all of these consumers here. So I don't think that should be split up. But the issue, though, that they actually just changed, but I think there are other things that probably need to change too, is Amazon essentially forced their suppliers who sold on Amazon, they did not allow them to sell their goods on other websites at lower prices, which as soon as you start enforcing what people that work on your site can do elsewhere, that's a problem. So I don't think the solution for all of this is like big, spin-offs or anything like that. It's really just looking at the nuance and determining really like on the deal making, the contracts and like rules level, what are they allowing or enforcing that shouldn't be allowed?
Setting aside what we discussed with Apple and Spotify, because I do think, to your point, I do think that Spotify has a pretty good case there. But setting that aside, I think another thing that separates two of the companies we've talked about from the others is the issue of privacy. In the case of Facebook, in the case of Google and Android phones and sort of the tracking that goes on, I think that those two companies have to answer, literally have to go up to Capitol Hill and answer tough questions in a way that those questions aren't really being asked, nor do they necessarily need to be asked of Amazon or Apple. Because they don't really have the social media stuff. Yeah,
I mean, I think privacy is increasingly going to turn into a thorny topic. And we see with GDPR in Europe how it helps consumers in some ways, but it also keeps the incumbents strong and it makes it harder for competition, which is the exact opposite of like what we're talking about right now that politicians are trying to go after. So I do think that we will have to approach that. The other side is, do governments really want to enforce like privacy at the end of the day? Because then that takes away their access to information too. Technology, is going to be agnostic with privacy. It's not going to prioritize some groups over others, probably like we've seen in China. I don't think that's the way it's going to play out here. So I do think it's going to get thorny and much more political and very annoying. But I do think privacy is the end game, and companies like Facebook, they're not going to be putting privacy on like their ad business, but when it comes to messaging and stuff like that, that's going to increasingly be the norm.
Our email address is marketfoolery@fool.com. Question from Ellis Laura. Ellis writes, I wanted to get your thoughts on esports and possible investment ideas. Similar to movies, video games are a hits-driven business, and I don't feel confident enough in only investing in a few video game publishers. Would you recommend buying an index such as ESPO or Gamer, or creating a gamer basket of stocks? Thanks for all the great advice. ESPO and Gamer, GAMR, these are ETFs built around video game companies. Just did a quick look on Google Finance, and ESPO launched last fall, basically flat, and the Gamer ETF launched almost exactly 3 years ago today. That ETF up about 67% over the last 3 years. So I'm curious what you think about this, because my sense is that you're bullish on esports in general.
Yeah. So I have a couple of things to say about this. One, you talk about video games being a hit-driven business. I think that is true, but it's actually increasingly less true. I think a lot of companies are finding ways to keep their top franchises generating recurring revenue for longer periods of time. You look at something like Call of Duty, it's been around for 15 years. And you look at things like sports franchises like NBA 2K or FIFA, like those come out every year. So there are counter examples to this being a hit-driven business. And
well, wait, isn't that like, maybe we're splitting hairs here, but I look at that as like, oh yeah, Call of Duty was a hit, and they're going back to that well in the same way that Disney, came out with Iron Man and that worked, and they're like, hey, maybe we can start making these Avenger movies.
Okay, yeah, maybe it was a hit at some point, but I guess I was thinking about it more of like these one-off hits that come up ever so often,
like Candy Crush.
Yeah, or,
King Digital comes out with Candy Crush.
Sure,
and that's basically the reason to buy that company.
Yeah, or like Take-Two right now with Red Dead Redemption 2. It made $700 million in its first weekend, but what was it doing for like the 3 years before? Nothing. Like that was a hit, and it drove that business, which I don't necessarily think is bad. Hits are great, but anyways, I do think that we're moving a little further away from a hit-driven business, more to like recurring revenues. Some franchises have been around for a long time. Some games continue to do stuff every year. Mobile is even a different beast. I do think that you can do fine with an index or ETF. I looked at the ones that you threw out. I think Espo is maybe the slightly more interesting one. It has a great mix of publishers from all around the world. It's not just a US-centric one, it's a global one. It also has non-publishers like NVIDIA and AMD, which I don't know, I have mixed opinions on. And the other thing to be aware of is costs, but it doesn't look terrible for this one. So I think that's okay. You can invest in this ETF and do fine. You'll have exposure to the industry, which I think is going to do well. Maybe unsurprisingly, I do also think that you can do better by picking individual stocks, because then you don't have to also own all the obviously bad companies that get thrown into ETFs too. So I don't know if people are interested. Maybe I could work on a basket or partner with JMO on something, since he's the basket king around here. I can work on that. I will kick that basket off today with a couple of things that I would right now put in it, and that would be Take-Two, which I just mentioned with Red Dead Redemption, and Tencent, which is the largest video game company in the world. Those would be the two stocks that I would seed the basket with, but maybe I'll have to work on the rest.
Is part of your picking those two the fact that they're kind of beaten down over the past year?
Well,
they're certainly cheaper than they were.
They certainly are, but I think that goes for pretty much every video game company right now. I think Take-Two, to me, stands out above Activision and EA in particular right now, because they are breaking records, they're laying a clear foundation for growth, and they're operating with a little drama. You can't really say the same thing for Activision and EA.
I was just going to say, I mean, just the stories I read about Activision Blizzard and executives leaving that company and going to start their own businesses, it just seems like, say what you want about Take-Two Interactive's performance over the past year, they don't appear to have a talent problem.
No, they're doing everything right, in my opinion. I do think the other video game companies will bounce back too, but Take-Two doesn't have as many difficulties to work through, even though they've been beaten down just as hard. Tencent, I mean, they're the largest video game company in the world. They're the largest video game company in China, and I think that's powerful. And also, if you look at what's been going on in China over the past year of video games, the government put a freeze on new game approvals. That's obviously something that's going to go away over time, and they're poised to be the #1 beneficiary when that happens. Also, if any of these other companies want to bring their games to China, they're probably going to partner with Tencent in order to do it. So Tencent is very well positioned in video games, and they just have a ton of other stuff going on, like WeChat and all the other investments that they've made. So I feel very good about these two. They're two different businesses, but this is what I would seed my basket with.
Didn't Tencent spin off their music to its a separate IPO? I thought they did that last year.
They did that with music, and they actually did it with China Literature, which is like a ebook service.
Do you think they would do that with their video game division?
No, because I think one thing that people don't realize is one of the largest synergies that they have between the gaming business and their social media business is that they can advertise their games in social media. Also, I don't think they're looking to raise that much money because it is a good business, unlike some of these other companies that they spin off in order to raise money that's separate from Tencent's core balance sheet. So I doubt that'll happen. It's too core for them.
Aaron Bush, thanks for being here, man.
Thanks for having me, as always.
People on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against, so don't buy or sell stocks based solely on what you hear. That's going to do it for this edition of Market Foolery. The show is mixed by Dan Boyd. I'm Chris Hell. Thanks for listening. We'll see you tomorrow.